What's up guys, welcome back to Money Crow, the channel all about making your money grow. In this video, I'm going to explain how paying high expense ratios or paying an investment advisor what's called an AUM fee or assets under management fee can be detrimental to your investment returns. We're going to go over the pros and cons, but obviously I'm biased when it comes to this and strongly believe you should take the initiative to learn about investing and take control of your own assets and your future. Let's begin by first explaining what an expense ratio is. The expense ratio of a stock or asset fund is the total percentage of fund assets used for administrative, management, advertising, and all other expenses. An expense ratio of 1% per annum means that each year, 1% of the fund's total assets will be used to cover expenses. So to bring a real-life example into this, let's say we want to invest in the S&P 500. Two of the most popular funds for this are SPY and VOO, but they have different expense ratios. While SPI is more liquid due to their massive volume, if you're buying with the intent of simply holding, VOO wins because they have an expense ratio 3 times cheaper than SPY. Now let's look at what an AUM fee is. This Investopedia article sums up AUM fees really nicely. They found that the average fee for a financial advisor's services is 1.02% of assets under management, or AUM, annually for an account of $1 million. An actively managed portfolio usually involves a team of investment professionals buying and selling holdings, leading to higher fees. Financial advisors that offer passively managed portfolios tend to have lower fees, and hiring a fee-based advisor, not a commission-based one, can also help lower the cost of a financial advisor. I absolutely agree that fee-based advisors, especially fiduciaries, are the better choice if you need the guidance of an advisor. A financial fiduciary is an advisor that acts in your best interest when helping you make financial decisions. I'm going to explain why, although that 1% AUM fee may appear low, it can have enormous negative effects on the growth of your investments. I'm also going to explain what you can do to avoid these unnecessarily high fees. Before we continue, I just want to give a quick shout out to my amazing Patreon supporters. We have our standalone Crow CEO, Jorge Ledesma, and our 4 Crow investors, Prismatic, Erica, Andrew Paz, and John Harden. Thank you all so much for your continued support. If you're new to the channel and you want to be notified every time I make a trade in my $100,000 portfolio, consider supporting the channel on Patreon. I post all my trades on there, so you'll be the first to see them. Link is down below. Another easy way to help out the channel is by clicking my 3 different referral links so we can both get free stocks and free cash. For a limited time, Webull is giving away 3 free stocks, M1 Finance is giving away $10 in cash, and Robinhood is giving away a free stock like Apple or Facebook or many others when you sign up. Links are all in the description. Thank you guys. While researching this topic, I came across a wonderful article by the website advisorperspectives.com. The data they found claims that actively managed funds underperform on a risk-adjusted basis. So not only aren't you getting all the returns the market could provide for you, but you're also paying a fee on top of that. Let's look at what they found. Large-scale studies have shown that actively managed funds underperform their passive benchmarks on an absolute basis. New research shows that this is also true on a risk-adjusted basis. And this is true across asset classes and subclasses. So basically what this means is that, say there's an investment advisor and he's picking his own basket of individual stocks that he thinks will provide a greater return than something like the S&P 500, for example. His benchmark would be considered the performance of the S&P 500 because that's what he's comparing his fund to and saying he can do better than those returns. So this investment advisor is charging people an AUM fee every year just so they can have the privilege of having their cash invested in the assets that he's choosing. Let's say in 2021, his fund provides 5% returns, and in that same year, the S&P 500 provides 10% returns. He would be underperforming his benchmark. And this underperformance is unfortunately pretty common when it comes to these professional funds that are actively managed, based on the findings of the SPIVA, which we'll go over right now. Since 2002, S&P Dow Jones Indices has published its S&P Indices versus Active, abbreviated SPIVA, SPIVA, scorecard, which compares the performance of actively managed equity mutual funds to their appropriate index benchmarks. While their SPIVA scorecards persistently demonstrate that large majorities of active funds underperform their benchmarks, even before considering taxes, in absolute returns, they do not address the claim that active funds may be superior to passive investment after adjusting for risk. With that in mind, using standard deviation as the measure of risk, they developed a risk-adjusted scorecard. So what does that mean? In other words, their research already proved that passively investing in low-cost index funds provides greater returns than investing in actively managed funds. But now what they want to find out is if the risk-adjusted returns of actively managed funds are better or worse than passively investing in low-cost index funds. A simple way to explain risk-adjusted returns would be if a fund returns 9% on average and on its worst year it loses 20% of its value, it would be considered a better risk-adjusted investment than something like the S&P 500, which has had 10% returns on average, but lost 38% of its value in 2008. That's obviously a bit of an oversimplification and there's more math involved, but generally if you can obtain very similar profits while only risking half the value, let's say, like 20% versus 38% in this example, then it becomes a very attractive option for a lot of people on a risk-adjusted basis. So this is what they found in their 2019 report. Over the last 5, 10, and 15-year periods, 84%, 97%, and 92% respectively of actively managed large cap funds underperformed their benchmark. Over those same periods, 65, 80, and 86% of actively managed mid-cap funds also underperformed their benchmarks. Surprisingly, for small cap funds, it was even worse. And this exposed the myth that actively managed funds work better in supposedly inefficient asset classes like small cap stocks. And the underperformance issue wasn't only with US funds. We see the exact same problem with international equity funds. And this is also across all categories like large, mid, and small cap stocks. They found that over those 5, 10, and 15-year periods, 75%, 80%, and 89% of actively managed emerging market funds underperformed, exposing the other myth that actively managed funds work better in inefficient asset classes like emerging markets. And similar results were found for small cap international funds. A large majority of actively managed fixed income funds in most categories underperformed over all three investment horizons. At the 15-year horizon, at least 60% of active funds underperformed in all categories. And in only 2 of 14 categories, fewer than 78% underperformed. The worst performance came in the supposedly inefficient asset class of emerging market debt, where over 10 and 15-year periods, not a single active fund outperformed. And over the 5-year period, 98% failed to outperform. Those are all really insane statistics that clearly show how it makes no sense to delegate your investments to a third party. Not only do you have a huge chance of your money underperforming the market, but you're also paying a fee in order to underperform. But let me go against the grain and reveal some situations where it would be a pro rather than a con to have your assets actively managed. This is for the person that's thinking to themselves, but what if I don't know anything about investing and I have no interest in learning? Or maybe you just have no time to put in the research and execute your own trades with a proper strategy. Although I would personally argue that it only takes a relatively short while to learn the basics and you can keep your investing strategy extremely simple, if you absolutely won't budge, then this is where I would recommend hiring an investment advisor to manage your funds. But since you're here watching this video, I'll bet you're part of the crowd that already knows how to or wants to learn how to manage your own money. So I just want to reiterate that you'll potentially save tens of thousands of dollars, if not millions, managing your own money. But if the two options are, number one, I'll never invest any money because I don't know what I'm doing and I never want to learn how to, and number two, I'll hire an investment advisor and invest with them. 100% hands down, go for option number 2. Another scenario where I'd recommend hiring a financial advisor and paying them a fee for managing your money is if you suffer from the psychological aspect of your investments losing value. A proper financial advisor will sit down with you and explain different asset allocations and determine an investment strategy that correlates to your risk tolerance. But even then, if seeing your portfolio lose value and having the ability to sell everything and liquidate your funds out of panic is right there at your fingertips, that's much more dangerous than paying a professional an annual fee to explain things logically rather than emotionally and keep you invested for the long term. More pros about investment advisors are that they can sometimes provide very valuable resources like tax planning, estate planning, long-term care planning, and develop spending strategies and investing strategies to help you meet your goals. If you guys enjoy this type of content, I would really appreciate it if you like the video and subscribe to the channel. Thank you guys so much. We learned earlier that expense ratios on funds pay for administrative, management, advertising, and pretty much all other expenses. There are many funds that have expense ratios at or over 1% per year. For our example, let's assume we choose a fund with a 1% per year expense ratio. We also learned earlier that the average AUM fee, assets under management fee, for an investment advisor managing your portfolio worth $1 million is 1.02% per year. If you have a smaller portfolio, it might be the same fee, but often it'll be higher since they won't be generating sufficient profits from a lower balance. But for our example, let's keep it simple and assume 1% in AUM fees. So if you're paying an investment advisor 1% AUM fees, and say we also buy that fund that we talked about with a 1% expense ratio, we're spending 2% of our portfolio every single year on just fees. Let's see exactly how much profit you would be sacrificing if you were giving up 2% per year. This is an investment fee calculator that also lets you add additional annual contributions to your account. Let's assume someone saved up $6,000 in cash and approached a financial advisor with the goal of investing that $6,000 and another $6,000 every year after that, starting at age 18. Their goal is to retire 42 years later at age 60. We're going to assume that the investment advisor can get the same returns as the S&P 500's average annual return of 10% per year. Even though we learned earlier that the majority of actively managed funds underperform a passive fund like that. But let's still assume this advisor is top-notch and can at least match that rate of return over the long term. Here are the results. If this person managed their own finances properly and kept all the gains for themselves rather than paying high expense ratio fees and assets under management fees, this person would have $3,876,986. But since they pay 2% in annual fees, they instead are left with $2,123,534. Still a very respectable amount, of course, no argument there. But for someone that understands how fees affect performance, we can see that this person gave up almost half their returns with such a small sounding fee of 2%. $1,753,451 in fees over their investing journey. Now, just for fun, let's pretend we're able to cut both the fees in half. So now we're only paying 0.5% AUM and 0.5% expense ratio. What if I told you we're still sacrificing over $1 million in that scenario? I hope after seeing these scary numbers, you pull up your investments and see if you're paying an AUM fee or an expense ratio fee. Now let's go back to that 2% number for my next example. As the numbers get larger, you can see how much more this can affect you. Let's say this person is investing $2,000 per month instead of $500. So they would start with a balance of $24,000 at age 18, hire a financial advisor, and contribute an additional $24,000 per year. Let's assume this person has the same goal of retiring in 42 years at age 60. I'm sure most of you would agree that paying $7 million to an investment advisor and for fund expenses is absolutely ridiculous. If we divide that number that we get, $7,013,805, by 42 years, we get an average annual fee just under $167,000 per year. So that's basically what you paid throughout your entire investment lifetime. And if you retire with that same advisor and you still have that same fund that you're invested in, you'll continue cannibalizing your retirement savings each and every year for the rest of your life. That's crazy. So what can we do? How can we avoid paying these outrageous fees? The number one thing we must do is educate ourselves and become financially literate in order to at least understand the very basics of investing. A few years ago, I read this book called The Little Book of Common Sense Investing. It's written by John C. Bogle, and I would recommend it to anyone getting started investing. I don't even have an Amazon affiliate link yet, but in the future, if I get one, I would only recommend things I read, use, or actually believe in. But currently, I have nothing to gain by recommending this book to you, other than the feeling of knowing I'm saving you potentially thousands or even millions of dollars in fees, which is what this channel is all about. John C. Bogle, the author, is actually the founder of the enormous brokerage firm Vanguard that manages most of the funds I recommend, like VTI. And he's actually the pioneer of the index fund and has always kept his fees as low as possible. This has helped millions of people save collectively probably
billions and 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 billions and
something like 100 billion.
By the way, VTI, that fund I'm always recommending, is an example of a low-cost index fund. He could have easily become a multi-billionaire by charging more fees and going public to shareholders with his company, but instead he passed all his good intentions and low fees onto his clients. He passed away in 2019 at age 89, but he accomplished so much in his life. Warren Buffett had this to say about him: "He did more for American investors as a whole than any individual I've known. A lot of Wall Street is devoted to charging a lot for nothing. He charged nothing to accomplish a huge amount." I think that perfectly sums up what John C. Bogle was all about. And by reading this book, you'll understand why the average person doesn't need an advisor and is better off investing in a low-cost index fund like VTI, which again, I recommend all the time, and I will always recommend it all the time. VTI has an expense ratio of 0.03%. So if we plug that into the example where we paid $7 million in fees, we're now only paying $141,278. I don't know about you, but I'll take that fee any day over a $7 million fee. I hope you guys learned something new. I encourage all of you to see what kind of fees you're paying now and to avoid paying excessive fees in the future. Thank you all so much for watching until the very end. I hope you'll be back for future videos. And as always, please subscribe, hit the notification bell, like, and comment. Have a great day, and I'll see you next time.